All right, hey everybody, TG Watkins here. Let's do a audio visual check, make sure we got everything up and running and working, and then give it just a second till more people get in here. Of course, everything is recorded as usual. And yeah, we're gonna go through this. Gosh, I looked at it, it was a little over 30 slides, and I've got a lot to say about a fair amount of them. So we will probably, I figure an easy hour for something like this. And if you guys want to go a little bit further, we can go a little bit longer. That's fine. And then, but I think most of the information I was able to actually kind of get into the slides. So it was in this case, like we've kind of been adapting how we've wanted to do stuff. And sometimes it's easier to just give a couple little bit of slides and actually just dive right into the markets. But I was finding this time I really wanted to show things, and I needed to keep capturing stuff that required some work in order to demonstrate it properly, as opposed to just going back into current stock charts and all that kind of stuff. I do have a list of charts and things that I am interested in showing, so we'll kind of go into that. And then, if we got time, if you guys want to hang around, got questions, and we can do that. So I think everything looks pretty good. And of course, this will be recorded. Not sure if I said that already. And then it'll be also on our YouTube channel. So looks like it's 2 minutes past the quarter hour. So I think we'll just kind of get into it and go from there. Looks like we got a good number of people. We got all Lorna, Mirza, Lee. Thank you guys. And I know Sarah is also going to be in here, and she'll be capturing some questions. So I'll kind of be looking around if there are any particular questions in the moment. But really, for the most part, you guys, they'll be capturing any general questions, and we have a document that I'm watching, and I will be able to see those questions later and what to do about them. So yeah, don't worry about that. Your questions will be answered and addressed, or at least captured. All right, so bear market, right? We are now officially in a bear market. And I was kind of saying this earlier today during some of our live sessions. There's kind of like what traders know and what retail people know. And I think everybody in here is considered a trader because you're here, you're learning, you're part of it, and you're hearing from us, and you're learning all the little tips and tricks. So I'm sure what the media and the talking heads and what the general population probably thinks when they hear, oh, we are officially in a bear market, they're like, crap, and we got to sell. And it's actually probably counterintuitive that once you officially reach a bear market, it's probably going to bounce. So, right? So that's kind of what we're seeing and what's going on. Steve, I'm on the West Coast. I'm up in Washington State. So as the word and the message goes out that the market's in trouble because we're in bear market territory, we're actually going to probably start going higher from here. Now, I don't know how much, I don't know how big or exciting or eventful or short squeeze. I'm actually kind of thinking it might be a little bit more dull and dead than that, but I'll show you what I'm seeing. All right, so a couple things we're going to be going into: how to adjust your strategy after a correction. This is less of a correction. This is more like a bear market. Okay, so that's another thing that we're going to have to make sure we clarify on, and find out what sectors I'm targeting next. Hint, big of it one is retail, and then get my view on the market action. I'm definitely a technician here, so I like to get down to the nitty gritty, and then what to do to prepare yourself if you haven't already. Because at this point, if you haven't been noticing, you're pretty late to the game. But I think everyone here is pretty well dialed in. All right, so we've got a nice 3-day weekend. In fact, today's Thursday, so I need to keep making posts out there to the Moxie traders that Monday's closed. All right, we've got Memorial Day weekend coming up here, so you guys take 3-day weekend, enjoy it. I'll have to see if I can actually get some time on the boat. And then other than that, just make sure you guys take some time away from the market. It's been tough, it's been neurotic, and just take a breather. When you come back, maybe you'll see things a little bit differently and see some clarity. But for that, we do have a 20% off sale, selected courses, all that kind of stuff. That just want to let you guys know about that. All right, yeah, so who am I? What am I doing here? My name is TG Watkins. I'm director of stocks, and you can follow me over here on Twitter and Instagram. And then just a quick little blurb about me and my history in case you guys don't know me. But I've been doing this for a very long time. I first actually started looking at charts when I would sit on my dad's lap when I was about 3 years old, because my dad would trade and manage his own money. And I remember he took me to my first stock trading seminar when I was 12 years old. And I remember asking one of the presenters off to the side, I said, is this really possible? And they said, yes, it is. None of us were born knowing how to trade or to be traders. And so we had to learn it. And if you can learn it, then you can teach it. And if you can teach it, you can learn it. So that was really the big thing. That was the biggest takeaway I ever had when I went to one of these seminars. And that's what's carried me through. And now look at me, I'm on the other side of the microphone. So, if I can do it, you guys can do it. All right. And then a little bit about me as far as my trading style. My dad and I are both pilots. I grew up in just an aviation type household, and very mechanically oriented. I'm very engineer minded. And so that's what I do. I bring that into the stock market. And, with pilots and stock traders, you need to be disciplined. Otherwise, you'll kill your account. So that's kind of important to make sure you follow your checklist, your rules, and just stick to them. And for me, it's kind of being a market pilot. My goal is to try and get you guys there as safely as possible. Sometimes it's easier and sometimes it's harder, but we're always trying to look out for you because we're trading our own money as well. And we really try to make sure that we get where we need to. Right now it's a pretty difficult time in the market, but there is opportunity. Might be challenging, but there's a lot to learn here. If you guys are new to the market, you will be cutting your teeth in a very interesting time, and you'll learn quickly. All right. So some of the other things that was interesting in through here is I knew as I was making this presentation, I knew a lot of the things that I had said over the last couple of presentations. So I dug them up and I went through them. I'm like, well, that's interesting. A lot of these things did come true, and it's very interesting to see where we are now. So notice this whole slide was from January 31st, 2022, that presentation that I had. You can see where the market was at the time. And I was saying, think about it, 20% correction is also at a consolidation area. Well, again, what did we just hit this week or even last week? We're at 20%, so that pretty much happened. Now, how it happened was the difficult part. I was thinking, let me get to the next slide. So, okay, first off, we hit a 20% correction. That's in the bag. Now you can see I wrote down here and I said, I'm not sure where we're going to go, but it's something to consider. Just putting it out there. At the time, I really thought that this was going to be kind of a dip buy correction, but that has all changed, absolutely changed. And so now if we're in a bear market, this is actually looking more realistic. Now, of course, we're not going to go straight down there right yet. There's going to be all sorts of bounce and twists and turns, but I would not be surprised at all. And I think Sam Seamus is with me on this one too. I would not be surprised at all if we got down to the SPY weekly 200, which is something around 340, 350, 330. Gosh, it could even go further. Okay. But I think we're probably going to be coming down here. And the reason I say that is because across the board, individual names I am seeing at least come down to the weekly 200. A lot of them have gone beyond that, but most names that I'm seeing that are starting to break and hit downtrends have been heading towards their weekly 200s. So that is something to consider. When I made my presentation back there in January and I was looking for this and said, hey, this is awesome, 20% correction, then we're going to turn around and buy the dip and rip on up out of here. And, we want this. Well, that was when I was talking about this from 1998 as just a reference point that I was able to find, where we got a pretty quick 20% correction. We came back up and then we had a 50% move in the market and it was all great. Now it lasted a year and a half, and then we rolled over into the .com bubble. And that's why I thought, well, maybe we're not quite, maybe we're not quite here yet to the .com bubble kind of thing. Maybe this is just that 20% correction, then we move up. Well, here are a couple things to note of how things have changed and what I'm showing you as to with the difference between a 20% correction and now we're in a 20% bear market. Back then in 1998, notice this is the monthly 10 SMA. Notice that the monthly 10 SMA kept going up, okay? Price basically dipped below, and its dip and recovery were so quick, so fast, that it didn't affect the monthly 10 SMA. But what you'll notice is when it did start going into a bear market, notice that the 10 started to roll over. And now notice where we are today. Today in 2022, we are definitely below, we're 20% below. That's as far as math goes, that's not the problem. The problem is how long it took and what that's doing to the moving averages. Notice that currently the monthly 10 SMA is starting to roll over. That is not a correction. That is a bear market, okay? And that is something I talked about in the January 31st presentation, if you guys want to go back and look at that. What you can see here also on the weekly for 1998 is that price came down. It did tap the weekly third ATR and then quickly recovered, got the 8 EMA back over the 21 EMA, and then get back on the 50 and then resumed itself, right? Well, look at where we are now. Yes, we also had price hit the third ATR. We also had price hit the third ATR, but you do not see any recovery. In fact, right where it could have recovered, if it was going to look like this, it rolled back over again. The 8 stayed below the 21, price stayed below the 50, and price stayed below the 30. So you can see here what I wrote in the words, recovered quick back over the weekly 50, prolonged, fell back again below the weekly 50. So you can just see there are structural differences between this kind of dip correction and a bear market correction, even though they both went down 20%. So really, really cool, fascinating stuff to see in through here. I love going back and studying this stuff and bringing this up to the surface to show this to your attention. It's really neat. All right, here was another one. This slide was from January 31st, 2022, when I made this presentation. And this is the IWM weekly and daily. And I said, what are we in for? And remember, I said, hey, I'm seeing a lot of stocks head towards their weekly 200s, just like I said 5 minutes ago. And you can see here, back from January 31st, I already called it and predicted and said, hey, I would not be surprised to see the IWM go towards the weekly 200. Well, where are we? I didn't put up a chart because I think we all know where we are. We are literally right there. I think it was I forget the number, but we're right there. We are sitting at and slightly below the weekly 200. So yes, there was a whole lot of noise in between, but we got there. So that is another thing that I was able to call and saw. And again, I think the S&P is going to do the same thing, but there's going to be all sorts of twists and turns in the meantime. There was a lot of activity in the IWM in order to get there. So it was not necessarily an easy path. All right. Then I think you guys are probably all familiar with Michael Burry. He's the guy from the Big Short, the movie. And I've been collecting information out here, and this is one of the things I've heard. He's been talking a lot about this because he seems to be the guy who really can see bubbles and can see when markets roll over. So that's maybe his claim to fame. And here we are again with the market in a bubble and starting to roll over. So he has been pretty active as far as talking and stuff. So the one thing to note about this is I kind of said, well, throw the kitchen sink at it. That is exactly what our government and our Fed did basically for COVID and into the final stages of a very long bull market, since 2009. So what he's kind of saying, and honestly, what we're seeing out there as the problem is that over the last 18 months, 850 billion in direct stimulus checks, 400 billion in cash out refinances, 1 trillion forgivable loans. And of course, some of that was fraudulent, so be it. And then another 4 trillion indirect, which I think that is pretty much the Build Back Better plan and stuff that got pushed through over the last year, something like that. And if we're already starting to see the market roll over and inflation, all this kind of stuff, he's asking the question, well, what recapitalizes the consumer? Because we are 3/4 of our economy is consumerism, right? And consumer demand. And so if we've already put this much money into either the economy or people or our society, well, one, where is it gone? And two, we're kind of out of ammunition. Interest rates are super low, and just because the labor market's tight and so wages are going to go up and be prosperous, higher wages cannot beat this kind of stuff that the government can do. Okay, so that's what he's really trying to say there. And so what kind of ammunition do we really have left from the government? They're already trying to actually take money out of the system. They're trying to do quantitative tightening. So there's something to think about. Here's another thing on top of that. If we are already at the top of the market, and if we're starting to see these things roll over and do the things that we're experiencing, well, what about the consumer? What about increased wages? Like, where is that money? Where'd that money go? Because here, if we actually look at consumer credit slash debt, let's see, in March of 2022, it went up prior month, well above market expectations. It was the biggest monthly gain in consumer credit since December of 2010. And on an annual basis, consumer credit grew 14%. Okay, here's the chart. So obviously in 2020, during the pandemic, savings went through the roof, credit went down, debt went down, and savings went through the roof because we were all just not doing anything until we started to buy stuff online. But that's where even the government and our Fed and politicians were saying, hey, actually, the consumer, the average household now has a lot of cash on hand. They're not doing anything. And then, but now look, we have not only look at this. From 2018, it was more or less a flat line. Yeah, there was debt and kind of did its thing and whatever. But we went from going negative to having big reserves of cash and savings to somehow we keep going up and up and up. And now we have more credit, more debt than ever before since 2010. This is actually pretty incredible and pretty astonishing. Maybe this is a function of inflation. There are a lot of thoughts and theories behind this as to what's going on and why this is. And it is just something I think we need to know about, because again, if the government, the Fed, put all this money into people, into society, into the hands of us, well, we shouldn't then be racking up our credit card debt. Like, that's kind of the thing. Like, why is our credit card debt going through the roof? And we can't go blow more money into the economy because we're already in debt, as far as consumers. So yeah, you're kind of like pulling your hair out on something like this, being like, what the heck is going on? But I think it's important to note that we might be getting ourselves into a bit of a trouble. We're getting ourselves into some credit crunch, honestly. I think that's what's happening here. Another way to be looking at this is house price to income ratio. We all know that the housing thing went crazy because interest rates went historically low, and so you could buy more house for the same price because interest rates were lower, and so we got a housing boom. And yes, it's a bubble, but it's a different bubble than 2008, so it's not going to quite probably be the same kind of stuff. But houses across the board went up 35%. All right, they just boom, 35% higher. But the amount of house, home price to the amount of income we all have, it has shot up to, as you can see, just crazy levels. There was some craziness in between, and now it's just up there. It's 130% income to house price ratio. Okay, so another thing, we're probably going to start seeing some foreclosures. Interest rates have now doubled basically, and we're over leveraged. We're over leveraged. They have too much house for not enough income, and we're probably going to see some ramifications from that. You guys saw the last presentation that I had, market update. I did this. This time I included the ticker. So if you guys want to go find it yourself, just go type that into your Thinkorswim, ticker icon. They have a few of them. They have regional, local, Southwest, East, West, stuff like that. This is the national one. And I went into depth with it last time, so you can go look at my last presentation. But the idea of a blow off top, I'm going to show you more slides that are just charts about what a blow off top is. I think you guys, for the most part, know what that is. But it's when prices, doing a nice trend, and then it does a hockey stick. That's usually a blow off top. All right. Now, 2008 was kind of like that, but it just kind of went parabolic. But this is clearly some sort of blow off top, and you can see it is just in the nosebleed section. So again, I don't know what's going to happen. I don't know if it's going to necessarily crash or whatever, but we're starting to reach basically unsustainable levels for the housing price and economy. Because if you just look at the stock, if you just look at the chart, here we are, stock traders, and so we try to see everything through a chart. Well, this is the best thing I can show you. And I know you're probably hard to see this, but just look at the moving averages. And it was really cool to see in 2006, actually, where price got underneath the monthly 10 SMA and then actually got rejected by it. And then that was the confirmation of the downturn. So if you guys are realtors or you're looking for homes or something like that, this might be a good chart to decide, okay, hey, when are we going to buy and sell Apple? When are we going to buy and sell Tesla? Well, when are we going to buy and sell homes? This might be a really good chart for you, because I know that I probably want to keep some powder dry, that if I can pinpoint when we're down here, maybe I want to go out and buy a house or buy some investment property or something like that. So this is some really good stuff to be aware of for your own personal or business needs. All right, here is another past slide. ER, is there a scenario that maybe you think that we're not in a bear market? Yeah, a huge turnaround. We're gonna have to get on top of moving averages, and everything's gonna have to turn around. Like things are just gonna have to turn and be rosy. And basically, I think everyone calls it, when the Fed capitulates, when the Fed finally turns direction, because right now they're squeezing, they're tightening, they are trying to reduce money supply. If they say, oh, sorry, and they start actually loosening again, sure. But they're not going to do that. This is going to be a while. So yeah, far way away. All right, this was another slide that I took from January 31st, 2022 for that presentation. And I said, are there any safe places to hide? And the short answer was no. And in the case, I just happened to use Hershey's. You could see that the market pulled back right here, and you can see Hershey's went sideways. That's basically the best you could kind of be looking for. Well, this is not a pullback correction. This is a bear market that we're in. And so things are a little bit different. Hershey is up right now. We are seeing some staples go up. Oil is up. But I will say, when we do finally get to the point where the market crashes, because we have not crashed yet. We've moved down 20%. We've had some pretty exciting moves, but we have not crashed yet. We have not capitulated yet. There's still more to come. And I'm going to, again, towards the end of this presentation, I'm going to reference this to oil. And I think oil is going to be our sign and signal as to probably when the market's actually going to crash. And that might be part of the economy too. But generally speaking, I think that be careful. It's harder and harder to find any safe havens right now. And part of that example are these companies that are acting as canaries. Here is Walmart and Target. And I think we know what happened, I think it was last week, that they both came out with earnings reports and they got crunched. So Walmart dropped basically 20% in one day, I think. And then Target dropped 25%. Well, maybe Target dropped 25% in one day and Walmart dropped 20% in 3 days. I think that's what it was. The only time these companies saw bigger drops was during the 1987 crash. That's a long time ago. Okay, we're seeing things that have never happened before, or at least haven't happened in a very, very long time. This demonstrates that consumers are changing their behavior due to higher costs on literally everything, and especially gas. Because if your overhead is costing so much more, your disposable income is just going poof. Okay, companies can't pass all their higher costs onto consumers, and so their margins are going down. Now, I know that there's been some political talk and stuff out there saying like, well, companies are gouging and all this other stuff. It's like, if they are, they can only do it for so long before their numbers start to get affected. Or if they keep gouging, then people are just not going to shop there, not going to buy stuff, and then their numbers will suffer. So one way or another, their numbers are going to suffer, and their profit margins are going to get squeezed. So where on the previous slide where I said, hey, during a correction or a bear market, is there any safe place to hide? Well, we're starting to see that there are fewer and fewer safe places to hide. Oil, natural gas seems to be about the only place that I'm really kind of finding that is comfortably safe. Even that it's a relative term. Now, one thing as far as the Moxie indicator that I want you guys to point out. Now, I don't trade Target. I don't trade Walmart. Wish I did, because I didn't see this coming as far as a huge move. But the setup was there. If you guys trade these stocks and you have the Moxie indicator, the Moxie indicator was telling you on Walmart for months that this was not a good stock to be in as far as a larger time frame. Why? Because the Moxie indicator was below zero for months since the beginning of 2021. I'm kind of eyeballing it right there. So every time that price was over the weekly 50 and the Moxie indicator was below zero, that's called an inverse trampoline move. It's a definable setup. It's in part of my rule book as far as what's going on there. So this was a false long. That was not a good setup. It was not confirmed. And lo and behold, it happened. How about Target? A little bit closer to home and a little bit more dialed in here. There's our Moxie price trigger. saying, hey, energy on this time frame, the weekly, has now gone from positive to negative, and this move trying to get up over the weekly 50 while the Moxie indicator below zero is an inverse trampoline move, and it just got crunched. So some of these inverse trampoline moves, the 50, 250 moves, these things have been working like charms lately. I wish I could be trading all of them, but I keep coming across them. I'm like, man, I wish I had known about this, or this stock sooner, because the patterns are really just playing out. Now, the interesting thing is, notice where both of these fell to. The weekly 200. It's the same thing I said about the IWM. It's the same thing we've been seeing about stocks all over the place. At least it seems their first target, if they're going to start moving down and they're going to head someplace, the weekly 200 / third ATR is their target. Now, they might continue to go further down. They might bounce first. We don't know. But look, they both hit the same place. The IWM hit the same place. So that's kind of why I'm saying, where do we think the S&P is going to go? S&P is probably going to go to its weekly 200. All right. Now, it's going to be all sorts of twists and turns. We don't know when or how or what path it's going to take, but I bet you anything, based on everything I'm seeing, that the S&P is probably going to at least hit its weekly 200. So we'll check back in a few months and see if that call is correct. All right. Another thing from Michael Burry, one of his tweets was talking about, profit margins and all this. Watch the profit margins fall, and then watch the price to sales ratio fall. This is early in an inflationary stage. Pricing power runs ahead of sticky wages and supply contracts. Like, think about it. Companies have supply contracts that are months or years in length, and they can't change them, or they can't get out of them. So they're already priced in. It's like, oh man, I have a contract to buy lumber at X dollars, even though now lumber is either cheaper, and I can't redo anything. I have to honor this contract, so they can't get out of it. Same thing with wages. It's really hard to hire and fire employees, right? It's very sticky. You care about the people. You don't want to lay somebody off. We're all fellow humans, and we don't want to do that. And we know that the ramifications of somebody losing their job can kind of be a big deal, because it may be hard to find a job. And especially if a lot of other people are losing their jobs at the same time, it's hard to find another job. And so people try and keep them on, or can't change your wages. You can almost never go down in wages, right? So it's really tough. And so inflation kind of starts eating into, well, your profit margin, because that's what goes first before the supply contracts and wages. We are seeing things change rapidly. Last year, we started seeing, everybody was hiring and needing workers and all this stuff. And so McDonald's was offering $1,000 bonus just to come join them. There were all sorts of bonuses that were being handed out in order to get and attract employees. But now, this summer, we're starting to see hiring freezes. And we're actually starting to see companies lay off employees, like big companies, Netflix, Amazon. We're starting to see this stuff. Angie, I'm going to get to that one too. So yeah. All right. And then another thing, this is pretty interesting. I don't know too much about this kind of stuff, but here's the website. If you guys want to take a screenshot, go check out this website. I thought it was really interesting what's going on. Again, this is really kind of macro stuff and dollar and rubles and currency stuff. It's not really my forte, but I've been doing a lot of reading out there, and I do subscribe to a lot of other things. And I thought this was pretty interesting as far as how this might be affecting our world and the United States as a reserve currency. And just that there's some crazy stuff going on with the whole Russia-Ukraine thing, and then we're involved as a proxy war, and then China and Taiwan and all that kind of stuff. So it's a lot of stuff that the market's going to have to handle and deal with in our economy and our stock market. Couple points. Precious metals are not necessarily a hedge against inflation, which we're kind of seeing because the gold is still not moving, even though inflation is rampant. They're a hedge against the dollar collapse. Okay. Well, the U.S. weaponized the dollar by denying Russia access to its own dollar reserves. So yes, we've been doing all these sanctions, but what other countries have realized is that if we can cut off Russia from their own dollars, our dollars in their banks, then other countries are like, well, our dollar reserves could be at risk if we don't if we don't behave properly according to the U.S. government. And they're like, we don't like having our money in something that somebody else has control over. And so they're starting to change stuff. Russia is making countries pay for their commodities in rubles, which is now, the ruble is now stronger than than before the conflict. I mean, it went almost to zero, but now it's even stronger. Other countries are seeing this and are already trading in other non-U.S. currencies, which threaten the hegemony. Man, I even practiced that earlier. I knew I was going to screw it up. It's a weird word for me. The petrodollar. So, that whole thing about Saudi Arabia and everybody paying for oil in US dollars and us being a reserve currency. Jerome Powell admitted recently that it's possible to have more than one reserve currency. We haven't had to talk about that in over 50 something years, right? Or even longer. And then talk about gold and stuff like that. China and Russia have the largest gold reserves. So, they're fine. They got plenty of hard assets. All right, now as far as some of the charts go, because I'm a technician, I love to look at this stuff, and this is what we're going to be, looking at. And what I wanted to show you, here's Boot. All right, this is a stock that I even talked about this in the last presentation. We are trading it, and what I want to show you is just from a chart standpoint, talking about that blow off top, right? And I talked about this for the housing, Case-Shiller Housing Home Index. Look at how Boot was just chugging along, doing its fine, okay, good, in a trend, and then suddenly explodes. And I even saw that at the time. I made lots of posts about that. I said, this thing, that's a blow off top. And sure enough, it was. And you can see here, it even did a head and shoulders. Okay, blow off top and then head and shoulders. Well, here's the SPX monthly currently, 2022. Kind of doing its thing, chugging along, like whatever. Had a couple dips in between, like, okay, fine. But clearly something has happened, something very different, right? This is now what looks to be a blow off top. All right, so we've got all sorts of crazy stuff going on there. Just recognize the similarities in these patterns and what they mean going forward. How about here's 2000, SPX 2000, kind of doing its thing, chugging along, having a good time. And then we basically hit the .com era and boom. Now it was a huge one, but you can see it did the same hockey stick type maneuver, blow off top. Okay, well, what happened? When it was done, it got underneath the moving average and went down. How about 2008? Chugging along, doing its thing, following the moving averages, and then, whew, housing situation. Market goes up. Pretty crazy time, right? It's the best before it's the worst, right? And so that was a blow off top, and then you can see it got underneath the moving averages. All right, how about on the way down? What is it that we're expecting when things start to roll over? Like, what kind of guidelines? What are we following? What are we looking for? Well, I talked about this before. I talked about this in the last presentation or two of them. And you, on the way down, you follow the monthly 10. So look at 2000, monthly 10, monthly 10, monthly 10. It wasn't until it was able to finally get over, like do a double bottom, get over the monthly 10, that it changed. But it kept following. Even though there were some really big rallies and really big dips, you could see it generally followed the monthly 10 on the way down. How about 2008? Monthly 10, monthly 10, then it had it whoosh, and it wasn't until it finally got over the monthly 10 that it got out of the bear market. All right, where are we today? We are crossing below the monthly 10, and it could be argued that maybe by the time the monthly moving average continues to grow, it might angle down a little bit sharper. That might touch. Or what if we get a big bear market rally, right? What if we get a few or a couple months sideways to up, and we get this, and we get that? Wouldn't that be exactly that? That's what I'm saying. So even if we get a bear flag or we get a bear market rally, watch and know that we're only going to go up to a certain point. And it might be hard to see in the moment on the monthly chart because it's 1 month at a time, and moving averages are lagging indicators. So we won't really see it in the moment, but later you will probably see exactly this, that price and the monthly 10 hit. So keep that in mind. ER 123, if you see a big move to the upside, don't think that we're out of bear market. Watch for that monthly 10. Be aware that that thing is overhead. All right, so Angie, here, I think this is going to address your question a bit. How close is the crash, right? Because we need to, it's not over until the fat lady sings, right? We need this thing to roll over, puke, capitulate. Like it's going to have to get bad. That we know that the Fed needs the market and the economy to basically get crunched. They call it a soft landing, but we know that they need to throttle this thing back, and it's a blunt instrument, and we know that things are going to go down. All right, we're going to have to clean the slate. We're going to have to start over. We're going to have to be like a phoenix rising from the ashes in a way. Okay, that's pretty much what's going to have to be happening out there. And as I've been going back and studying a lot of these charts, and of course, these are just guesses. There's slight predictions, but they're just, let's look back at history and see if there are any things that we can kind of pull out from history to understand where we're going in the future. So this may happen, this may not happen. It might happen in a similar way. It might happen not at all. But I am finding a lot of consistencies. I'll put it that way. So what we can see here, let me get right here. You can see, there. You can see I kind of drew a line here because that was the more or less the double top, where it pulled back, came up, and then rolled over. That was the last peak. Well, I found here kind of the same thing. We had kind of the last peak over here. Dip, came up, last peak. So I figure that's kind of where we start go. That's our go signal. And then I was looking for, okay, well, we're kind of a double bottom and a bounce. Well, right in through here, that's where we had a double bottom, bounce, had kind of a double bottom, bounce. And where was the bounce? Well, in this case, it came up to the 50, which more or less kind of came up to the 50. This is from 2008 to where it is now. And then we roll over in a pretty hard way. You can see here in 2008, that was a pretty stiff move to the downside. And you can see currently it was a pretty stiff move to the downside. Basically hit the third ATR on both of them. And then we bounced. Now, I'll show you a daily chart later. This is a weekly chart. But you'll see here on 2008 that the bounce really kind of only went to the weekly 21. It kind of got right to the weekly 8, but it kind of went to the weekly 21, which, if you guys know my terminology as far as an elf shoe, where does the arch of the foot normally go? 21 EMA. And if you're going to short something, where do you short it? At the arch of the foot, which is the 21 EMA, which is exactly where that went in 2008 before the market really rolled over and crashed and got crunched. And it sure looks very similar. Just something to keep in mind there, that if we don't get a massive bounce, or if we just get a kind of a move up, keep an eye out and see if price goes basically to the weekly 8 and kind of taps the weekly 21 overhead as the arch of the foot. And look for that. And that's the similar that I see here. Of course, as I said here, it's hard to predict. These are just ideas. It's something to watch for, seeing if history repeats or rhymes. And there's always the idea that maybe price needs to bounce further. Maybe price needs to come up here to the weekly 50. That's a possibility, okay? Just trying to give some ideas out there. None of this is set in stone. Now, here is well, I'll show you one more thing. Just so this weekly 21, so that you understand where our location is, our context, this weekly 21, the weekly 21 EMA, is basically the same thing as the daily 50. Okay, so same moving averages and basically the same configuration. So here we are, same charts, just on the daily time frame. Same place, same location, same bat signal on the daily time frame. And what you'll see, here was a double bottom, that double bottom I talked about. Here's that other double bottom on currently 2022. We got this bounce. Now, here's why I think this relates closer than some other ones, is because in 2008, this bounce got price over the daily 50 and then essentially ran into the daily 200 while the 50 was underneath the 200. Notice that combination. And you'll see this is basically that same combination. You guys know me, the Moxie indicators. I talk about the 50-250 maneuver. This is that. You'll notice that price was able to bounce over the daily 50, but notice that the 50 was below the 200. And then it came back down to the 50. You can see it kind of hung there for a little bit and then crunched. And you can see the same thing happened right here in 2008. Came down to the 50, spent a couple days, and then got crunched. Now, here's the next thing. This is why I said it's eerily similar. This is really kind of crazy. This move that we then got once it fell off of the daily 50 was a big move. Notice here that price basically ran the lower third ATR for 2 weeks. However long that was. It ran it for several days. Just methodical selling, running that third ATR. No real capitulation, no real super panic, just marching it down. And that's what we saw currently. That's what we've seen over the last 2.5, 3 weeks. And we've seen the VIX. The VIX has been elevated, but it didn't explode. right? So the VIX and the UVXY was telling us that there's no real fear, there's no real panic. This was all built in. This is all expected. This is all planned. So you can just see marching down that third ATR. And it sure looks, I mean, this series of events between the double bottom, the bounce, and the 50 and the 200 and the third ATR, man, it looks really similar. The only thing I'm then noticing is that currently this is happening much faster than in 2008. You can see just the width. This happened over a much longer period of time in 2008. This is a compressed version of that. So all of this, everything we're looking at, might actually happen sooner than we think, which could be a good thing. You know, maybe we just rip the Band-Aid off and we go down and do all this stuff quickly, and then we can get on with our lives. Like, let's go have a really fast correction or bear market. Let's go have a fast recession. You know, let's just rip this Band-Aid off, clear the decks, and get back on with our lives. Maybe that's a good thing. The next thing I really kind of want to express to you guys is notice the bounce that we got. You know, remember that bounce that went up to the weekly arch of the foot, the 21? Well, what was that on the daily chart? It went up into a downtrending daily 50. And what you'll also notice is how messy was it? It was really messy, very choppy, up, down, up, down, up, down, okay? And it did it so slowly that the 50 had time to move down and met price. Price didn't go up to meet the 50. The 50 actually kind of came down to meet price. And this is something that I've been talking about and just expressing ideas to our traders and to us, and even to my own mind, that what if we don't necessarily get a rip-roaring bear market rally? What if this is actually just kind of a really messy, choppy flag sideways that drifts up, bear market flag, and takes several weeks, 4, 6 weeks, until the daily 50 comes down and meets price? You know, we just need to be prepared for that. Like, this may not be a very exciting summer, depending on how we look at this. It could be very messy, very choppy. And if we start to see these telltale signs of it just looking more and more like that, then it seems to me that if price runs into that, that could be the next wave down. So Angie, I think that answers your question. Watch for price to run into the daily 50. It's going to take time. And then we'll see if things start to fall apart and unravel and where the economy's at like that. And we'll just see if we rip that Band-Aid off, and if that's what really gets the market to really roll over and really puke. That's what we're looking for. Like, we're looking for a waterfall where people are going, oh crap. And that's what's going to then send the VIX and the UVXY to like 60, 30, 60, I don't know, something like that. So that's kind of some interesting stuff to be watching for, right? Just put it out there. Now, here are some stats. Yeah, ER, you're already getting ahead of me. Yeah, we're getting there. All right, so 1969, 1974, I could only go so far back using Thinkorswim, but I think you guys get the point. What I'm trying to show here, death cross, right? The death cross is when the daily 50 crosses the daily 200. So see that, and then see how far price went down and how long. Look how long it took. And so from there, look how far it went and how long it took. And you'll notice that the 50 stayed below the 200 the entire time. It wasn't, you could, of course, we could be ahead of this, but one of the signs, here's the, I don't know if it's a death cross, called a live cross, when the 50 crosses back over the 200. You can see that here too. So we've got a ways to go, and look how long that took. Here are some stats. There have been 17 bear markets since World War II. They averaged a 30% drop over the course of 12 months. If there's no recession, a 24% drop, the market dropped 24% and took 7 months. So shorter, sweeter, okay? If there was a recession, a little bit longer, 35% drop, and it took 15 months. So we are already 6 months off from the peak, and we officially have 1 quarter of declining growth. Who wants to put some, golden cross? I'm thinking of a few jokes right there. Thanks, Chuck. We are already 1 quarter of declining growth in. Who thinks that we're going to have a positive quarter this quarter? Probably unlikely, right? So if this next quarter is negative, then we're officially in a recession. All right. So that probably puts us closer to, dare I say, the 35% in the 15 months. Now, maybe it takes 12% and goes 35% because, everything's run by computers nowadays, and stuff just happens faster and further. That's an idea, because we know that we've been seeing some crazy stuff over the years because so much of the market is run by computers, and they tend to exaggerate where things go. Faster, further. So maybe we go, heck, just making it up. Maybe we go 40%, but we do it in 12 months. I don't know, but it's something to think about. Okay, here's 2000, 2008, and currently. Notice death cross. And then Chuck, to your point, notice the golden cross. And then look what it did. You know, just there was a lot of activity. There were some huge rallies, definitely some huge rallies. But what you'll notice is, you know, got rejected by the 50 and got rejected by the 50. So the 50 is important. And then you can see here, who's 2008. There's the death cross. There's the 50. You can even see again, there's the 50. And then somewhere over here, there's the golden cross. We know that 2000 was a 50% decline. 2008 was a 57% decline. And look at this. Here is the death cross currently for 2022, and we're only down 20%. So the point I'm trying to get across is this baby has just begun. All right. We've got, according to stats, we at least have 6 more months ahead of us, if not longer. And according to the stats, if we're 20% now, and we go 35%, we've got another 15% to go. Now, of course, it's not going to happen from here. It's got to get some altitude before it can roll over. So, you know, another 15% down could actually be something like 20 or 22%, depending on the kind of bounce that we get. You know, and that's going to be some big stuff. Okay. All right. Now this one, I thought this was kind of fun. I tinker around with Fibonacci's sometimes, and I kind of want to see if there's a way that I could somehow, you know, do a magic potion and figure out if I could predict where price is going to go. And I'm totally making this up. Okay. So you guys really need to understand this may or may not happen at all, but I kind of put a few things together that it's like, oh, well, maybe it's reasonable. So we're just going to have to watch this and see how this works over time. Again, totally making this up, but it was kind of fun putting this together. And I think it's a fun experiment to see if this actually works. So I noticed, I just happened to run a line 2008 right in through here. And I saw that there was a trend. Like you can see that there's an angle right here. And I was like, huh, okay, let me just run a trend line. And that trend line worked really, really well. And then because trend lines work both for the upside and to the downside, I then noticed, look how price then started getting rejected by the underside of that same trend line. My mind was blown. I was like, holy crap. I love it when things like that work out. You know, I'm sure some of you guys who use trend lines all the time are like, yeah, duh. But the point is, like, look how it went from support to resistance. And it worked really well. And so I looked at that and I said, huh, well, can I connect any dots over here? It's just barely the beginning of the market turning around, but we've got enough of an angle that I could kind of work with that, and we could even work with that low. And so really, again, just making this up, I'm trying to just strike a line and see where it goes. And so I did that. And then the next thing I did is said, well, you know, the 50 is pretty much in a straight line. So you can see here, and I just projected it out. And I'm like, huh, well, that worked for 2008. Well, how about I try it for now? And so I did that. And then to try and coordinate this thing a little bit further, I wish I made this line a little bit brighter, but this gray line, if you guys put this on your own charts, you go to about 4,900 and look left, there's actually quite a lot of support, a lot of congestion over, you know, historically on the left there, but it's also where price found some support right there. And you can see that there was some support right there. So I drew a trend line right there, and I was like, oh my goodness, look, it lines up right on the X. It lines up. It's just like, wow, this is cool stuff. And this is what I find fascinating about the market, is how some of this stuff, it's weird. It's really weird how it works out. And then, and you can even see that here on 2008. You can see I drew that line, that gray line, and look where it did. It basically went right where the X was. And then the other thing is, look where the X is. It's right where the daily 50 was. Like there are things that are lining up over and over and over and over that literally X marks the spot, because the 50 was there, the price level line was there, the you know, trend line and the 50 and all that were all right there. So I just tried to extrapolate and make one for 2022, and everything's working. And then I tried to get even fancier, and I threw some fibs on this thing. I threw some fibs on the B. So the current one on 2022 kind of worked out well. I went from the total peak to the total bottom, and the X again lines up at the 618 retracement. That's pretty cool. It's crazy how that worked. Now, it didn't work out as nicely on 2008, from the total peak to that bottom. It didn't really work out. So I just said, well, let me keep messing around. And again, maybe I'm totally making this up, but at least from this peak to this low, the X was also at the 618 retracement. So, if it didn't work on one, it worked on another one. And I thought that was fascinating. So sorry to spend a lot of time on this thing, but it just blows my mind. I think it's just wild. And it's going to be even crazier if I can capture this and actually use it later and be like, see? Now, the other thing, where did price go today? Today, price went to the 21 EMA. Where did price go here when it finally came off its low? To the 21 EMA. And after that, it overshot it a little bit, but it basically went to the 21 EMA. After that, where'd it go? Pulled back. And it pulled back to that trend line. Well, this is why I got out of my long trade today as far as the SPX, because it went here. I'm like, there's the likelihood that if we pull back, and if I'm right about all this trend line stuff, it's going to pull back here and basically take away everything I just made in 1.5 days. And if I'm right about that, then that means that I can buy here and ride it up again. And then maybe we can do that back and forth a few times. So really, really crazy, fascinating stuff that if this works out, I'm gonna go buy a lottery ticket. I'm gonna go buy a lottery ticket in like 4 to 6 weeks and then see if this works out. Yeah, Nasir, right? All right, so fun stuff there. And then, okay, so speaking of reverting to the mean, here's some more statistics. 9 of the top 20 S&P one-day rallies were during the 1929 bear market, okay? 10 multi-day rallies were greater than 10%, and they averaged 22.8%. 12 of the top 20 NASDAQ one-day rallies were during the dot-com bear. Okay, you kind of saw that earlier. 16 multi-day rallies were greater than 10%. They averaged 22%. So again, I see these stats, scratch my head, and I go back and I look at some of this stuff, and well, would you lo and behold, look at this thing, 11%. We already saw an 11% bear market rally. Crazy, huh? Just crazy. Love the stock market. It's just crazy, crazy stuff, how that works out. So 11%. So we probably have more to see. Now the question is, as I said, is this going to be a big rally or is this going to be a bear flag? We're going to have to wait and see about that one. But keep in mind that if we do probably get a big plunge sometime, we might get a big rally, and maybe we'll get a 22% rally at some point, because you can see on both these situations, the peak, the biggest rallies they average 22%. That's some fun stuff. Even this 11% rally was some fun stuff. If you could catch that, was a good time. All right, another thing to. No, Henry, I didn't really look at the IWM. IWM is kind of like neurotic and all over the place and usually just dies. So no, I haven't really seen similar. Okay, so here's another thing to be considered. Bear math is not as good as bull math. And while the waterfall, like the look of this waterfall looks incredible, and it is, because you're like, wow, that's a lot of money I could have been making on the downside that happened really, really quickly. The math isn't quite there. So here's the math. $10, if a stock moves from $10 to $100, that's 1,000%. All right. Now, of course, you can say 1,010 or whatever, 900. It depends on how you want to do the math. But basically, it's 1,000%. Okay. But if you took that same stock and went from $100 to $10, it's only 90%. So mathematically, we like bull markets. You make more money, they last longer, all that kind of stuff. We like them. All right. The math works better. So for as great as we might, like some of these stocks are absolutely imploding. And for as exciting as that might be, you will never make more than 100%. Okay. The stock can only go to zero and you can only make 100%. Now, I know a lot of you guys, I've kind of been talking about this. They're like, well, that's why we do options. I'm like, yeah, I know. But the point is, if we're just talking about stocks, then we can never make more than 100% on a move. Whereas if a stock goes up, we can make 1,000%. So, we want this to be over and done with as quickly as possible because we really want to get back on the bull side and keep going. Yeah, and Lorna, we learned that crude futures can go negative. So there's that. Anyway, yeah, zero. So we just can't make as much through stocks. Of course, options, it's a different thing, fine. But that's kind of what we're looking at. Now, as far as your account goes, think about this. And this is where preservation is important. if you have $100 account and you lose 50%, you can't just earn 50% to get it back. You have to earn 100% to get back to break even. So again, in this market, when the bear market's over and the bull market starts again, you need to make sure you're solvent. You need to make sure you have money to put to work, because if you don't have any money, you can't play the game. And so if you lose 50%, you've got to then, if you lose half your money, you then have to double your money just to get back to where you were. So capital preservation is very, very important. And then if you can see here, this is a DKS, this is Dick's Sporting Goods. Look at this move. This move was perfectly symmetrical, up and down. It went right back to where it began. It took 240 days to go 130%, but it took 185 days to only go 55%. And it was literally the same move. Okay, this is my point. You could make 130% on the way up, but you could only make half that on the way down, and it was the same move. So while it might be exciting to see these kind of things, and yeah, again, maybe for option traders, you guys are like blowing it out, but you know, just mathematically for stocks and the charts and stuff, it's you know, it looks better and more exciting than it is. Yes, it happens faster, but it still took 185 days to make 55%. I don't know about you, but that's like watching paint dry for me. So I'm having to adapt. All right, so on that, with DKS, talking about similar setups in retail, these are a couple trades where we are in these trades, we're short in these trades. And I always like looking around trying to say, okay, how am I needing to prepare myself for this? Because these moves are jagged, they are all over the place, they have huge rallies and huge move down, and then it's like, oh, I made a lot of money, and then you give up half of it, and you're like, what do I do? Do I want to stay in this? Like, what am I trying to go for? And again, I'm trying to wrap my head around this concept of watching paint dry, because sometimes I don't have the ability to be able to get into the right spots and not get chopped out, or to not miss the bigger move. So what I'm trying to do is look for the bigger, longer term trade, so that I can just say, look, I'm just going to hang on to this, and I have a goal of X%. If we take American Eagle Outfitters as an example, this thing, great trade, right? Great. That looks like a solid trend, just like that DKS. It went 47%. Hey, not bad. You know, you can grow your account by half, but it took 140 days. Maybe that's great for you. Maybe it's not. I don't know, but it is what it is. And we need to prepare ourselves for how long these things might take. And if we look for, you know, DXLG and Boot, they're retail. I'm preparing myself that I'm going to have to hang on to these things for probably another 100 days in order to make 40 to 50%. Just going to have to do it. And maybe if you want, you can decide to try and, you know, play it a little bit here and play the bounces. But if you want to just reach the destination, that's what you're going to have to probably just wrap your head around. The other thing, as far as these structures go, look at this trend line. Look how well that worked. Look at this trend line. See how well it's working, and look at this trend line and see what it's doing currently. They're all kind of at different stages and different phases, but look what they're doing. The other thing is, now we look at the Moxie indicator, inverse trampoline move. Price should not be over the 50 if the Moxie indicator is below 0. How about this? Inverse trampoline move. How about this? Inverse trampoline move. They're all doing the same thing. They're all slowly dying, and we're riding that train. The other thing we could see is, look at AEO. Once it started, it kept staying underneath the daily 50. What do we look at Boot? Now, there's a gap. Okay, so maybe it's going to come up and tap it again at some point. But basically, if price can stay underneath the daily 50, just ride that trend. How about DXLG? Had earnings today, went up. I wish it would have imploded, but it went up. Where's it at? Daily 50 and that trend line. So, you know, if I want 50% out of this thing, I'm going to have to say, okay, maybe I'll add more. But then I'm going to have to be willing to ride this thing for, you know, 100 days if I want all of it. Or maybe I go 10 or 20% increments, and I just try and catch when it's oversold, and then catch when it bounces, and catch when it's oversold, and catch when it bounces. You're just going to have to decide what you want to do about that. Here are some more examples to kind of drive that home. Again, DKS, what it do? Followed the 50, and the entire time the Moxie indicator was below 0. Inverse trampoline move. And you can see it did a pretty good job following that trend line. How about SIG? Started with an inverse trampoline move, continued with an inverse trampoline move, and 2 more inverse trampoline moves along the way. Now, of course, that would not be very fun to have to hang on to this. That would be a pretty wild ride. I wouldn't necessarily recommend it. But if you look at the greater picture, what is it doing? It's following the daily 50 down. So, take it for what it is. How about Big Five? We made our money off of this, and you can see that it had a really big rally that would have brought us all the way back to zero. But look what it did. It rolled over again. And if you can see, basically followed the daily 50 down. And when it bounced, what was that? An inverse trampoline move. So Moxie for the win. All right. The Moxie indicator is doing its job here for these things. Okay, so enough on that. This might be where some of you actually get really kind of interested. And even so, Angie, to your point, okay, when is the market going to really crunch? There have been some studies and some things that I've been reading about how the market may not crash until oil finally gives it up. And so I thought, okay, well, I can do my own research based on that information. So how about I go back and I'll research this myself and look at this. So is there an oil to SPX correlation? This is from 2000. Here is the SPX monthly on the left, and here is the oil futures on the right. And these arrows that I've placed are all in the same point in time, exactly the same point in time for each chart. And what you'll see that for 2000, look where oil peaked. It peaked basically as the market started to roll over. And then you can see it got underneath the monthly 10 as the market continued to crunch. And then in this case, last little bit, and then the market rolled over. And then, yes, it recovered. But the point is, oil peaked the same time the market did. All right. And it went down with the market. It did. So basically, the market did not have oil to support it. How about 2008? Notice here is your first arrow. So right there. Okay. In this case, yes, the market did start to roll over, but it only went down so far and kind of caught its breath, right? It's kind of like what we're experiencing nowadays. The market did go down. We did get 20%, but what did it do? Look at how it went sideways. It did not crash yet. When did the crash happen? Here are the two arrows right there, which line up with these two arrows, which line up with the peak of oil. So oil peaked, the market crashed. That actually seems to be a correlation, okay? So yeah, the market was kind of starting to fall apart, but oil was still going up. Market crashed when oil crashed. One thing I want you to see here, because I talk about gaps and moving averages quite a bit, notice that there was a gap right between price and the moving average. How often do you guys hear me say that? Off the 8, back to the 8, or there's a gap. Price is too extended because there's a gap. Well, there's a gap. So let's go to current. Here's where we are currently. You'll see, talk about that gap week that was demonstrating to us that price was super overbought, way too overbought, and that gap was going to be a problem because it's too much. It's too far away from its moving averages for support. It's going to be a problem. And what you'll see is just like 2008, that yes, the market has started to come down, but notice that the oil is still going up. It's still on an uptrend. The market, the S&P, has not crashed yet. So we will probably see the market kind of go sideways, chop around, something like that, and we'll see oil keep going up. But if there is any correlation, again, I could be making this up, but if there's any correlation, if we see oil start to falter and go down and actually start to roll over, and oil as basically the only bullish sector, if it starts to quit, then that might be timing wise what also then drives the market down. Because if oil is the only thing still really going up, then there's nothing left to hold the market up. And the one thing I'll note is we are starting to put in a gap. Okay. So oil, at least from this perspective and these moving averages, looks like it's getting so overbought that it's starting to become a little bit stretched and at some point probably unsustainable. So yes, oil is the strongest segment. Yes, they're moving. We've had a couple good days this week, but you better have your hand on the trigger and your stops moved up, because oil seems like it's basically in the last inning of its up move. It's just my prediction. It's my thought. It's my ideas. I could be wrong, but it's something to think about out there. All right. All right. That's pretty much it. I think we're a little over an hour. I think we actually just started at an hour. So I'll get to live charts if you guys want to. We'll just spend a few minutes there. But for anybody who's been watching this and they need no more information, I'm just going to wrap it up here and then we can go into Q&As and stuff. This is who I am. If you guys like how I see this stuff in the trading room, you come over here. We got live trading, interactive, all this stuff that we put out there, newsletter, trade sheet. I do have live trading sessions. This is the calendar of them. May 31st, I think, is our next one, which is probably right around the corner. And yeah, that's all of that. And then trade spreadsheet, we post every single trade that we take so you can keep track of it. And dashboard, you can see every single thing I've ever put out there, every single weekly video, all the live recordings, everything. And then, yeah, if you guys are interested, but maybe don't have the funds available, credit card, PayPal, put it on that PayPal credit, since consumer credit is going through the roof. Well, let's just add to it. So yeah, we got that. And then we got the socials. So yeah, if you guys are interested, we're running some Memorial Day specials. And I think we also, if you're interested in the trading room, we have a trial. And if you guys like the Moxie indicator and any classes that I teach, of course, we've got that for you too. So just a soft pitch, just let you know that there's stuff out there and kind of where to go from there. So that's about it. All right, let's look at some questions and see what you guys. Also, let me get some water. Yeah, so you heard that the momentum ETFs are selling out of tech and moving into oil. That sounds exactly like everything I've been saying. Yeah, oil is the last, looks like the last serious, decently safe place to go. Of course, there are some other names out there that are doing well. I mean, I've seen bulk shippers look like they're doing okay, but they've been, they've been chopping around a lot. So I'm real nervous on the long side. You guys probably seen some of my trades. It's like, I don't really want to, dive into something and then have the market kind of crunch or whatever. And again, we're in summer, summer doldrums. All right, well, not seeing many questions, so that's great. Sounds like I answered most everything along the way. Are there any particular stocks that you guys want to see for the moment in case? Chris, yes, I will be getting back into SPXL. In fact, that was the thing I covered when I was spending a lot of time on the X marks the spot slide, because we had price just get up to the daily 21, which is typically the arch of the foot, and we typically see price pull back from there. Now, of course, maybe it could jump up tomorrow, but then I would be expecting a pullback, and I want to see if it pulls back to the hourly 50 or to the trend line that I drew. Could even be both. They could be in the same place. And so that's something that I want to be looking for. And if the market does move kind of in a bear flag, like a choppy bear flag, we're going to basically become almost day traders. We're going to buy low, sell high, and just get out. We're not even going to wait for things to turn over because it's just going to be chop. We're going to wake up one morning and it's going to be down. We're going to wake up one morning, it's going to be up. It's going to be tough. So we're going to day trade. We're going to cash in when we can. And we're just going to say, okay, and say, all right, we made our percent. If it's 5%, if it's 8%, like whatever, we're going to have to basically shoot squirrels. Sorry, Sam, until we can get the big elephant, which is going to be the crash. All right. Or if you want to catch the elephant, you're going to have to eat that elephant one bite at a time by going short on AEO to get a 50% move over the course of 140 days. So that's what we're going to be looking at. Chris, love it. Thanks. You've been in Moxie for a year and you love it. That's good. Henry, yeah, thank you. Marlis, that depends. So are we no longer waiting until the end of day to trade? I mean, for the setups that I can see, I think that is still going to be an appropriate way to trade some short-term swings, because you could see that trading by the end of the day yesterday for the FOMC minutes, or even the day before that, would have been good trades because the setup was there. But if we get the move that we're looking for in 1 or 2 days, then we're going to take it. Okay, we're not going to really wait for our rules, because when the market is like this, to where it's just kind of chopping, price will move further than a supporting moving average, and therefore the next day it might come back down to that moving average, and then you've kind of wiped out most of your profit. So We're seeing moves go so far up and down in a short amount of time that the moving averages are not responding in order to give it a nice walkway, a yellow brick road, so to speak. They're just up and then down, up and then down. So yes, we could have a setup and it might spring itself up, which we need to capture because then it goes too far and then it's overbought for that time frame and then it's going to come back down. So it's going to be a little both. I still would prefer it to be end of day because the mornings can be a little neurotic and challenging, but yeah. Yeah, so that's kind of my thought right there. We're going to keep looking for setups, but we're going to also have to be a little bit fuzzy on some of these things. Let's see, Nasir, the other day I put up a flow chart for Moxie. Do you have more docs for your signature moves like elf toe, blow off top, trampoline? Yeah. So since you're in the room, you go up to the room drive, and it has the Moxie glossary, and it has the Moxie rulebook, and basically everything I've tried to put on paper. It's a quick cheat sheet guide as far as that. So yeah, it defines what the elf toe is. It doesn't talk about a blow off top. That's more like just a standard market thing. It does talk about the trampoline move and inverse trampoline move. Yes. Albert, nice. Yeah. Learn to navigate the market much better with my method. Significant improve with trading. You're welcome. As I said earlier, for those of you who are new during this time of the market, you're going to be learning a lot. Okay. You're going to be cutting your teeth here, and you're going to have to make sure you kind of instill yourself with good habits, and they will pay off dividends whenever this is all done. All right. January 31st, when I did my first presentation, I was pretty excited for the 20% correction that then was going to give us a good year. Well, it's not a correction, it's a bear market, and this is going to take a while. But when this is done, this is the kind of stuff. It's going to be not 2020 all over again, but coming out of a bear market, it's going to be good stuff, and it's going to last for a while. And this is where you make money to help provide for your generations. There will be generational wealth made whenever this bear market's done. Okay, this is good. It's burning down the forest, and green shoots can come up underneath. So stay solvent. Keep your powder dry when you can. Don't go crazy, and then we'll make a lot of money when all this is done. So just hunker down and make sure you got stuff to work with on the other end. I think, Mike, the trial probably lasts for 30 days, but we got, Lorna can help you there. Jerry, I don't know what DIN is. Let me look real quick. Too messy. Not really my thing. Now, maybe what you could do is you could short a bounce like this, because you can see here, it's had a habit of going up and then coming back down, going up and coming back down. But if you're trying to say short it as far as a trend, probably not. But if you want to short it to probably back to the hourly 50, that is probably what I would be targeting. You've got to wait for the right signal. But something like this is kind of my point, that in this market, you just trade high and trade low and trade low and trade high. You just kind of try and catch those moves on lower time frame charts, something like that. Chris, do I see AMD, SMH, Apple, IWM SPY being the best short plays? Well, those are all sorts of different stocks, and not necessarily. SMH has been a real mess. I tried trading it short a while ago, but it was so messy that I just passed. I just said, screw it, I'm done. Right now, the short side is not good right now. I think the market is overdone to the short side, probably needs to come up a little bit, and then it could roll over. So give it some time before you start looking at the short side. AMD, same thing. It will probably be a good short trade eventually, but not right now. Same with Apple. Apple is oversold. It's working on trying to get some altitude. Right now, if you want to trade, you need to keep finding stuff that is ready to kind of move up a little bit, all right? Because everything is so oversold. FDX, I haven't even looked at that one. That one's mostly just, again, it doesn't look like anything is ready as far as a trend. This is very challenging because the trends are very short. they last on the 15-minute time frame or the 5-minute time frame or the hourly time frame. You are not really getting trends on the daily time frame. Other than, say, this one, you're really not getting good trends. And this is going to be the problem and the difficulty is you're going to have to find stocks that either, if you're going to want a trend, you can find the trend like AEO, or something like this that doesn't really have a trend. You're going to have to figure out how you can trade these 3-day moves on lower time frames. And if that doesn't suit you, then don't trade this stuff. If somebody could answer Henry, I don't actually know that. That is the other side of the business as far as the Memorial Day sale. Cool. All right. Well, I'm sure, I know in Texas it's getting probably close to happy hour time. So we're going to let the team go. Thank you, everybody. Lorna, I'll see if anybody else is still out there. Lee, Mirza, Sarah, thank you too. And I appreciate you writing down the questions. And then, yeah, we'll cut it there. That way it's short and sweet. And then if you guys want to watch the replay, because maybe I talk fast, or maybe you wanted to really reanalyze something, just watch the replay. You can watch it to your heart's content. And then go read those articles that I put out there. There's some interesting things that might be going on with our geopolitical environment, for better or for worse. We need to kind of be aware of what's happening out in the world because it affects us through the stock market. All right, everyone. Well, then you take care. Thanks again, everybody. Go enjoy your happy hours, and we'll see you later.